I have transitioned my aggressive taxable account into the crazy aggressive dividends account. And you are about to see why I did it and what I'm investing in. Hey guys, this is Bill Schultz. First time you're seeing my ugly mug. I am doing this on my iPhone 6s, so I'm sorry if the video is not good. Hopefully it's just as good as many others. I did order a webcam that's supposed to be here tonight, C920, so hopefully that works out, and hopefully that'll make creating videos easier for me. So I decided to go aggressive with my taxable account originally, and now I've decided it's not aggressive enough. We want to go nuts, and lately I've been feeling like I want to take on more risk in investing. I know I have my Roth, which is, solid companies for the long term, and that's what I preach. And that's the way I'd prefer that you guys invest. So with that, disclaimer, do not invest like this. And I'm going to be doing a couple of portfolios. This is the first one that's kind of crazy, and you're going to see what I'm investing in and be like, Bill, you're on freaking drugs. What drugs are you on? Because you should not be investing this way. You're going to waste your money, you're going to lose it. But you know what? It's all in fun. It's all to make good videos and see what happens. I mean, what happens if I risk more money and take on more risky stocks and take on those stocks that are completely full of debt? And what's going to happen over the next year with this portfolio? Am I going to have companies go out of business? Am I going to lose all my money? Am I going to make a ton of money? Who knows? So I have transitioned my aggressive taxable account into the crazy aggressive dividends account. And you are about to see why I did it and what I'm investing in. And then I'm sure you guys can comment and tell me how nuts I am. So we're going to do that. And again, disclaimer, do not copy me. All right? Don't copy me. This is bad. Don't invest like this unless you seriously know what you're doing and have researched why you're taking on that risk. I have another portfolio that I intend to do, which will be even a bigger risk. Well, possibly a bigger risk. It could be even less risk, but it's going to be interesting. I have some interesting ideas for next portfolio I'm going to open up, and a couple portfolios actually. So in the meantime, stand by for that. But for now, check out this crazy freaking portfolio. So we'll see what happens. You want some entertainment? You want some excitement and risk and stupidity and craziness in investing? Then let's freaking do it. Why not? Welcome back, Freedom Savers. Today I am totally destroying and messing up my taxable account. As you can see, my pie is pretty foobarred right now. I'm going to make this much more aggressive and much more stupid in investing. So first things first, let me explain what I'm doing here. So I ran across this article. So I found this article, 10% high yield, 10 months, 2018 performance, including October's wild ride. And I just ran across this. I did a search on Google for something totally unrelated to this, and I saw this title of this article. So I clicked it, and I came across this guy, this high yield investor dude here on Seeking Alpha. And it talks about his strategy for high dividend yield stocks in retirement. And he has retired on this portfolio. He is investing only in what I consider very risky investments. He's investing only in business development companies, which I own one, maybe two. Maine is one of them. What business development company does is it invests in small to medium-sized businesses that banks won't necessarily loan to. So risk, right? They're just owning debt, right? And it's kind of risky debt because it's going to companies that won't necessarily get a loan from banks. So that's business development companies. They invest in all kinds of different stuff, and not necessarily all of them can't get loans from banks, but they invest in all kinds of different companies and different kinds, and there's different kinds of business development companies out there that invest in different things. So that's what a business development company is. The other half of this guy's portfolio is only MREITs. An MREIT is a mortgage REIT. So if you know what a REIT is, it's a real estate investment trust, and basically, those are companies that make all of their profit from real estate, or the majority of their profit from real estate. An MREIT makes its money from real estate, but it doesn't own real estate. It owns mortgages. So it owns the debt on the real estate. Again, much more risky, as the 2008-2009 recession and that stock market crash was all about mortgages. And bad mortgages. So it's much more risky if you don't know what quality of mortgages they're investing in. You know, if they give a loan out for a piece of real estate to someone, what's their credit rating? What's the chance of them paying that loan back and not defaulting? That type of stuff. So anyways, much more risky stocks than blue chip companies like Apple and Amazon and everything else that we have been talking about and investing in, specifically in my Roth. But he has made it work. And he's made it work because in the way he explains it is one of them performs better in a bear market while another performs better in a bull market. So it's kind of balanced with his portfolio being 50% of each. Also, it's diversified on the debt side of things. You know, for all debt stocks, it's very diversified because all the debt is in so many different sectors and different things that, you know, they've given loans out to oil and to energy and utilities or residential mortgages, commercial mortgages, warehouse mortgages, etc. So it's very diversified in that manner. It's not diversified in our normal thinking of diversification. But with the two things, he's saying it's a pretty stable portfolio. Now, he does admit that he hasn't completely tested this in a bear market, in a big recession. And there is a chance that many of these companies will cut their dividend during a recession. But what he's saying is that he's living off of 60% of his dividend income. Therefore, he has 40% to play with. So if one cuts a dividend, he can reallocate those assets to another one to make up that income without it affecting his lifestyle. So it's an interesting concept with a much riskier portfolio. And he does have the argument that is it really any more risky than blue chip stocks, because they're very volatile as well. I mean, look at the stock market lately. Everything's been very volatile. So I found this very interesting, a very interesting concept. And I figured, okay, this can give me a 10% plus dividend, and I take on much more risk, but it's possible. It's possible to make it work. So I figured, why not? I'm not putting a lot of money into my taxable account right now, and it is supposed to be my aggressive taxable account. And you know what, guys? It's not aggressive enough. No, it's not aggressive enough. Show me the money. So we're going to make this exciting. We want some entertainment in this investing portfolio here. I want to have one little disclaimer here, guys. If you're a conservative investor, like you should be, or a new investor, do not, I repeat, do not invest like this. It is not suggested or considered smart. All right, with that out of the way, let me show you my portfolio and what we're doing here. So, I'm going to go into my pies real fast because this is how I want my portfolio to look, maybe. A blank page. Yeah, that's exactly how I want to look. Blank. Empty. No. Refresh. Aha! Yay! All right. Where the hell did my pies go? My pie's not listed here. Well, I'm not sure why it's turned out that way, but let's just go back to our portfolio here. I created a pie called the High Yield, High Risk Portfolio. This is how my pie should look when I'm done. It will have two slices, which are actually pies themselves. So this guy's portfolio, this guy right here, this guy's portfolio, my God, people have opinions on this. All right, so this is his current portfolio. Well, actually, he changed one thing, so we're going to go to his latest. This is his portfolio. He has two sections. He has 50% BDCs and 50% MREITs, and these are all of them. So I have copied this and created a pie for business development companies and a pie for MREITs. And then I created a pie with both of those in that pie. So I will show you. This is his portfolio right here, basically, right? 50% BDCs, 50% MREITs. If we go into BDCs, there's all the stocks he listed, 20 of them, all right? 20 business development companies. And if you go in MREITs, boom, you got 20 of those as well. There's his deal. Now, I believe he gave the yields on each one of these for him. And with the yields that he gave, I believe he's putting in a balanced amount for the most part. So he's just putting the same amount in every one of these. So 5% in everything. I took the overall yield and correlated how much yield it provided and increased the target weighting on it. So what that means is the stocks that give me the highest yield have the highest weighting in the portfolio. So let me show you an example here on the MREITs. So my highest weighting is 10 here. That's because MORL has a 21.89% yield. 21.89% is the largest part of this entire portfolio, so it gets the largest weighting in the portfolio. And that's how I did it. I based it all on that, so I'd get the highest yield. Now, there is a problem. The problem with in the BDCs under BDCL, it shows 0 dividend yield. But BDCL actually has a 17.18% dividend yield. I've confirmed it on Yahoo Finance, I've confirmed it on Dividend.com, and I've confirmed it on ETF.com. It has a 17.78% dividend yield. For some reason, M1 Finance shows it doesn't have a yield. So that is going to drop my average that M1 shows dramatically. So my overall average should be higher. And if I could show you the pie properly, so this says that this overall portfolio, now by the way, this is his portfolio right here. This is my old aggressive taxable account, but modified. I had 6 holdings in it before, if you remember correctly. I now have 10. I wanted to make it an even 10 to balance it out. And there were some companies that I wanted to put in there. So let's take a look real fast. So here's what we had. We had BGS, we had AT&T, we had Good, we had Ford, and we had VGR. I have added Gladstone Capital. We also had Vector, and Masabi Trust, Gov, and MV Oil Trust. These are all very high yield trusts and companies. They're very high yield, and I added them. So that actually brought the aggressive taxable overall yield to 14.674% with 10 holdings. But I'm not going to use that by itself. This whole pie is one slice of my portfolio, of my main portfolio pie. So that's one slice. That pie is this slice of this pie, of my main pie. Then this slice of the pie is actually 2 pies inside this pie. So each one of these are individual pies. Hope all that makes sense. So it's nice and organized that way, blah, blah, blah. Now, here's the complication. How do I get my stocks? Because you can't just transfer stocks. I can't just move my current stocks from this pie into here, right? And so I found a video from, not that guy, this guy.
Hey, what's up, everybody?
He does all kinds of weird videos, not all finance, but this is a great video and the only video, only information I could possibly find on how to move stocks from one pie to another pie without selling them. According to M1's customer service, when he called, they basically told him he could not do it. It was impossible. But he found a workaround, and we're going to find out if it works. So what he found was, in order to move your current stocks that you own into another pie, right, that you can go into the deal itself, click buy sell the exact amount that you own, and then go into the new pie and buy the exact amount that you want to own. And under activity, no pending activity. So nothing should happen tomorrow to my stocks. I should have no sells and no buys, even though I have a sell order and a buy order pending. So in theory, it shouldn't sell anything. It should just move the stocks from here, this pie that I don't really want anymore, into this pie over here where I want them. In his video, nowhere did he say it actually worked. He did this and then said, look, tomorrow there's no pending transactions. And that's true. And this was 2 months ago, but he never followed up and said, this works. All right, so I don't know if this actually works or whether they're really going to sell my stock and repurchase my stock. And if that's the case, with price variations, I could lose money, I could gain money, etc., etc. I'm going to go ahead and set up the orders to move all of these and see if it works. So vector 73.22, we're going to sell 73.22. Come in here. Buy it. Nothing pending. Portfolio. All right. There we go. We got 1, 2, 3, 4, 5, 6 cells. And come over here. And we got 1, 2, 3, 4, 5, 6 buys. So in theory, those should move from there into this pie. And then what I'll be able to do, if I go here, if they move, they should hopefully disappear because they'll be at 0. I'm thinking they'll just be removed, which is exactly what I want anyway, because then I'll only have these 2 slices of the pie, the aggressive dividend stock and this one. And then all of the stocks I actually own right now will be in here. And then from there, we can deposit and see what happens. Because overall, I want this one to be 80% and that one to be 20% weighted. So when I put $100 in, $80 will go into this one and divide up between these 50-50. So $40 will go into this one, which will be $2 per stock in theory, but it won't because of the weighting. But anyway, you get the point. It's well balanced that way. So there we go. Let's see what happens, guys, and we'll go from there. I do want to go over some stocks here. I want to show you. I know that took a little while, and I'll probably edit a lot of that out. But I just want to show you that if this works, you are able to move your stocks that you own to another pie without selling it and causing tax consequences or losses. So we'll see what happens, and I'll let you know. But let's go over this guy's portfolio a little bit, shall we? Well, first, let's go over what I added. So I added MV Oil Trust. MV Oil Trust has a 22% dividend. This company is not really a company, it's a trust, which means it's just a holding company. And it holds the profits from MV Oil Industries LLC or something like that. Basically, it holds the profits from a private oil company. So that private company is doing whatever the hell it wants because it's private. It's not public. It doesn't have to report its earnings. It doesn't have to go through all that. It's private and it does whatever the hell it wants. And then they put that money into the trust and they give you the dividend out to the shareholders that are investing in it. So you don't have a lot of control over this. You don't have a lot of visibility over what they're doing. Only thing that you see is what's coming in and out of the trust itself. Risky, right? So number one risk, 22% yield. It's got to be pretty damn risky. Next up is Gov. Gov is interesting now because they are combining companies with, what was the other one called? There's another REIT out there, really popular. Anyway, these two REITs are combining into one and getting a whole new name on the stock market and a whole new company name. And if you didn't know, Gov actually invested in government properties that leased out to the government at all times. It owned the properties and leased them out to the government. The government has changed its policies over the years on how it handles these types of expenses. And with them purchasing this other company and combining, they are changing their whole company to be much more diverse in the real estate industry. So now they're going to have commercial properties, government properties, and they're just going to have a mix. That's going to happen. I forget when, but it's going to happen sometime in the near future. And this gives a 20% yield currently. So we're going to see what it does after this combination. Then I added Masabi Trust. Masabi Trust is again another trust company, another holding company for a private company, if I remember correctly. So again, high risk, high yield, 14.5% yield. Now I know you guys probably think I'm nuts here. You think, oh my God, Bill's lost it. He's freaking lost it. Because he's always talking about looking at financials and doing your due diligence and homework and stuff. I have looked at the financials of these companies, guys, and especially this guy's portfolio. I went through those companies thinking this is going to be a nightmare. Like there's no way I should invest in these. And I looked at them and I was kind of surprised. Like a lot of those companies with their debt levels and stuff and their income aren't that bad. Some of them are even comparable to the blue chip companies. Not all of them, don't get me wrong. There's a lot of bad ones. Well, I don't want to say bad. There's a lot with a lot of debt in there. And I mean, almost all of them have a lot of debt, but some of them I looked at and I'm like, wow, this is kind of comparable to Microsoft. This is kind of comparable to AT&T. So I was really surprised that they're showing a profitable business rather than, oh my God, they can't pay their debt. About, a third plus of them, though, definitely have more debt than they do assets in the short term. All of them in the long term, of course, don't have more debt than they do assets. I mean, that would really mean a problem. But for short term debt, they have some significant debt. I'll give you an example. NLY. Well, actually, NLY turned out not to be as bad, but let's just take a quick look here. If you look at NLY's financials, according to Yahoo, it's actually incorrect. So here's their income, right? Their revenue, income overall, net, right? So they're doing pretty decent on income there. 1.5 billion basically. But you go to their balance sheet, it shows current assets, which is like short-term assets. Like if they sold everything tomorrow, that's what they could get for it, right? Of 1.3 billion. But it shows current liabilities, which to my knowledge, current liabilities means these are debts that are due within the next year of $79 billion. Now, that's a dramatic problem, right? I mean, $78 billion of debt that they don't have assets to pay for. And their income of $1.5 billion sure as hell ain't going to pay for it. So what gives, right? Well, I actually went to Anal Capital management companies. It's an anal management company, just so you guys know. So I went to Anal Capital Management's website and I looked at their ANUS financials, and it turns out that they have a ton more cash on hand than this. Like their cash on hand, according to their filings to the SEC, is more than their actual short-term debt. They had like 90 billion in cash compared to 79 billion in liabilities. And the other thing about this is I'm not so sure that this is really in thousands, right? I mean, maybe this is actually a million. And the reason I say that is if you look at their freaking market cap, it's only 13 billion total. That doesn't mean much. They could still have 79 billion in debt, but it seems to me that it'd be hard to get a loan for 79 billion if your business is only worth 14 or 13. But what do I know? I'm not a business major on that. So anyways, just want to show you how risky these can be. Back to the companies I added. So I added those three, and then I added Gladstone. Now this one actually turns out to be pretty decent. I don't know why it's not opening for me when I click it. None of these are now. None of this is working. What the hell, M1? It's probably my internet. No, my internet's fine. So apparently M1 is foobarred right now. It is just down. I will finish this video tomorrow. Alright guys, thanks for watching. I appreciate it. Be sure to hit that subscribe button down below, and if you liked the video, hit that like button for me. If you want to hear any specific type of information, anything that you're interested in, you have any questions, just drop me a comment down below. Let me know what you think. Let me know your opinions on this video or any other video I've made. And if you know anyone else that might be interested in this video, please be sure to share it on your social media and share the knowledge. Thanks guys.